Introduction to Business, 2nd edition, an OpenStax textbook. Read along with the full text at openstax.org. This audiobook was produced by Open Audio. Listen for free on Spotify, YouTube, Apple Podcasts, or on our website at openaudio.us.
Chapter 16. Understanding Financial Management and Securities Markets. Introduction.
Learning Outcomes. After reading this chapter, you should be able to answer these questions. 1. How do finance and the financial manager affect a firm's overall strategy? 2. What types of short-term and long-term expenditures does a firm make? 3. What are the main sources and costs of unsecured and secured short-term financing? 4. What are the key differences between debt and equity, and what are the major types and features of long-term debt? 5. When and how do firms issue equity, and what are the costs? 6. How do securities markets help firms raise funding? And what securities trade in the capital markets? 7. Where can investors buy and sell securities? And how are securities markets regulated? 8. What are the current developments in financial management and the securities markets?
Exploring Business Careers. Vicki Saunders, venture capitalist and entrepreneur. Many women dream of starting their own business, but this involves a large investment of time, dedication, creativity, and money. Even the best ideas fall flat without strong financial backing and fiscal management. Most startups don't have a chief financial officer, let alone an unlimited amount of cash to fund their owners' dreams. According to recent reports, there are more than 14 million woman-owned businesses in the United States that employ over 12 million people and generate more than $2.7 trillion in revenues. And growth has increased for these businesses over man-owned businesses by nearly 60% between 2022 and 2023. Despite these impressive statistics, less than 4% of venture capital funding goes to this group of entrepreneurs. That's where Vicki Saunders and her venture capital startup Corliss, formerly SheEO, come into the picture. Saunders, who describes herself as a serial entrepreneur, previously co-founded and ran 4 different business ventures. She believes that the funding universe for women entrepreneurs needs to be fixed, and offers her plan via Corliss, a platform to enlist women activators to invest money to create a pool of capital distributed to select women-owned businesses in the form of 0% interest loans that are paid back within 5 years. The activators are more than just investors, however. Saunders envisions these women as being a crucial part of the businesses in which they invest, by providing operational support, resources for suppliers and other vendors, and a solid networking opportunity for everything from legal support to cultivating new customers. In a recent campaign called Radical Generosity, $1,000 was raised from each of 500 women, and that pool of $500,000 was split among 5 women-led businesses. In year 3 of the funding venture in 2017, Corliss funded 15 companies and invested $1.5 million. Corliss has funded entrepreneurs working on a variety of businesses, including artificial intelligence, hardware for people with disabilities, food, and education. Corliss currently operates in the United States, Australia, New Zealand, and the UK. And Saunders' goals for funding women-led businesses are lofty. The company has distributed nearly $20 million to about 200 women-led businesses. But her ultimate goal is to change the culture around how investors support businesses, all businesses. According to Saunders, activating women on behalf of other women will change the world.
In today's fast-paced global economy, managing a firm's finances is more complex than ever. For financial managers, a thorough command of traditional finance activities, financial planning, investing money, and raising funds, is only part of the job. Financial managers are more than number crunchers. As part of the top management team, chief financial officers, CFOs, need a broad understanding of their firm's business and industry, as well as leadership ability and creativity. They must never lose sight of the primary goal of the financial manager: to maximize the value of the firm to its owners. Financial management, spending, and raising a firm's money is both a science and an art. The science part is analyzing numbers and flows of cash through the firm. The art is answering questions such as these. Is the firm using its financial resources in the best way? Aside from costs, why choose a particular form of financing? How risky is each option? Another important concern for both business managers and investors is understanding the basics of securities markets and the securities traded on them, which affect both corporate plans and investor pocketbooks. About 62% of adult Americans now own stocks, compared to 52% in 2017 and only 25% in 1981. This chapter focuses on the financial management of a firm and the securities markets in which firms raise funds. We'll start with an overview of the role of finance and of the financial manager in the firm's overall business strategy. Discussions of short and long-term uses of funds and investment decisions follow. Next, we'll examine key sources of short and long-term financing. Then we'll review the function, operation, and regulation of securities markets. Finally, we'll look at key trends affecting financial management and securities markets.
$16.1. The role of finance and the financial manager. Learning outcome. How do finance and the financial manager affect the firm's overall strategy?
Any company, whether it's a small-town bakery or Whole Foods market, needs money to operate. To make money, it must first spend money on inventory and supplies, equipment and facilities, and employee wages and salaries. Therefore, finance is critical to the success of all companies. It may not be as visible as marketing or production, but management of a firm's finances is just as much a key to the firm's success. Financial management, the art and science of managing a firm's money so that it can meet its goals, is not just the responsibility of the finance department. All business decisions have financial consequences. Managers in all departments must work closely with financial personnel. If you are a sales representative, for example, the company's credit and collection policies will affect your ability to make sales. The head of the IT department will need to justify any requests for new computer systems or employee laptops. Revenues from sales of the firm's products should be the chief source of funding, but money from sales doesn't always come in when it's needed to pay the bills. Financial managers must track how money is flowing into and out of the firm. See Exhibit 16.2. They work with the firm's other department managers to determine how available funds will be used and how much money is needed. Then, they choose the best sources to obtain the required funding. For example, a financial manager will track day-to-day operational data such as cash collections and disbursements to ensure that the company has enough cash to meet its obligations. Over a longer time horizon, the manager will thoroughly study whether and when the company should open a new manufacturing facility. The manager will also suggest the most appropriate way to finance the project, raise the funds, and then monitor the project's implementation and operation. Financial management is closely related to accounting. Many organizations will have an executive position, such as the VP of Finance or the Chief Financial Officer, that is responsible for the financial management of the firm. But the accountant's main function is to collect and present financial data. Financial managers use financial statements and other information prepared by accountants to make financial decisions. Financial managers focus on cash flows, the inflows and outflows of cash. They plan and monitor the firm's cash flows to ensure that cash is available when needed. The financial manager's responsibilities and activities. Financial managers have a complex and challenging job. They analyze financial data prepared by accountants, monitor the firm's financial status, and prepare and implement financial plans. One day, they may be developing a better way to automate cash collections, and the next, they may be analyzing a proposed acquisition. The key activities of the financial manager are financial planning, creating financial plans, including forecasting and budgeting, Cost control, analyzing and monitoring costs, and, when appropriate, implementing measures to cut costs. Investing, using the firm's resources to fund projects, weighing the costs and risks versus the potential returns. Financing, securing funding for the firm's operations and investments through the balance between debt, funds borrowed, and equity, funds raised through the sale of ownership in the business. The goal of the financial manager. How can financial managers make wise planning, investment, and financing decisions? The main goal of the financial manager is to maximize the value of the firm to its owners. The value of a publicly owned corporation is measured by the share price of its stock. A private company's value is the price at which it could be sold. To maximize the firm's value, the financial manager has to consider both short and long-term consequences of the firm's actions. Maximizing profits is one approach, but it should not be the only one. Such an approach favors making short-term gains over achieving long-term goals. What if a high-tech firm in a competitive industry, such as Panasonic, chose not to invest in research and the development of new products? In the short run, profits might be higher because the company was not investing in research and development, which can be expensive. But in the long run, the firm is likely to lose market share and competitiveness, and therefore profits, because of its lack of new products.
Exhibit 16.2. How cash flows through a business. Cash flows into and out of a business through several primary activities. Cash flows into the business from 5 key sources: owner's investment, borrowed funds, the sale of fixed assets, the collection of accounts receivable, and direct cash sales. On the other hand, cash flows out of the business for 4 main purposes: the purchase of fixed assets, the payment of expenses, the purchase of inventory, and the payment of dividends.
This is true regardless of a company's size or point in its life cycle. At Corning, a company founded almost 200 years ago, management believes in taking the long-term view and not managing for quarterly earnings to satisfy Wall Street's expectations. The company, once known to consumers mostly for kitchen products such as Corelle dinnerware and Pyrex heat-resistant glass cookware, is today a technology company that manufactures specialized glass and ceramic products. It is a leading supplier of Gorilla Glass, a special type of glass used for the screens of mobile devices, including popular Apple and Android products and other digital display panels. The company was also the inventor of optical fiber and cable for the telecommunications industry. These product lines require large investments during their long research and development, R&D, cycles, and for plant and equipment once they go into production. This can be risky in the short term, but staying the course can pay off. In fact, Corning announced plans to develop a separate company division for Gorilla Glass, which now has more than 70% of the phone screen market, with over 8 billion devices sold. In addition, its fiber optic cable business is thriving as providers such as Verizon have doubled down on upgrading the fiber optic network across the United States. This growth is largely due to the increased 5G network and the construction of data centers. In early 2026, Corning entered into a multi-year agreement with Meta to facilitate their AI data center expansion. The company's revenues were up nearly 14% in 2025. As the Corning situation demonstrates, financial managers constantly strive for a balance between the opportunity for profit and the potential for loss. In finance, the opportunity for profit is termed return. The potential for loss, or the chance that an investment will not achieve the expected level of return, is risk. A basic principle in finance is that the higher the risk, the greater the return that is required. This widely accepted concept is called the risk-return trade-off. Financial managers consider many risk and return factors when making investment and financing decisions. Among them are changing patterns of market demand, interest rates, general economic conditions, market conditions, and social issues, such as environmental effects and equal employment opportunity policies.
Concept check. 1. What is the role of financial management in a firm? 2. How do the three key activities of the financial manager relate? 3. What is the main goal of the financial manager? How does the risk-return trade-off relate to the financial manager's main goal?
Sixteen point two. How organizations use funds. Learning objective. What types of short-term and long-term expenditures does a firm make?
To grow and prosper, a firm must keep investing money in its operations. The financial manager decides how best to use the firm's money. Short-term expenses support the firm's day-to-day activities. For instance, athletic apparel maker Nike regularly spends money to buy such raw materials as fabric and foams, and to pay employee salaries. Long-term expenses are typically for fixed assets. For Nike, these would include outlays to build a new factory, buy automated manufacturing equipment, or acquire a small manufacturer of sports apparel. Short-term expenses. Short-term expenses, often called operating expenses, are outlays used to support current production and selling activities. They typically result in current assets, which include cash and any other assets, accounts receivable, and inventory that can be converted to cash within a year. The financial manager's goal is to manage current assets so the firm has enough cash to pay its bills and to support its accounts receivable and inventory. Cash management. Assuring liquidity. Cash is the lifeblood of business. Without it, a firm could not operate. An important duty of the financial manager is cash management, or making sure that enough cash is on hand to pay bills as they come due and to meet unexpected expenses. Businesses estimate their cash requirements for a specific period. Many companies keep a minimum cash balance to cover unexpected expenses or changes in projected cash flows. The financial manager arranges loans to cover any shortfalls. If the size and timing of cash inflows closely match the size and timing of cash outflows, the company needs to keep only a small amount of cash on hand. A company whose sales and receipts are fairly predictable and regular throughout the year needs less cash than a company with a seasonal pattern of sales and receipts. A landscaping company, for instance, whose sales are concentrated in the spring and summer months, spends a great deal of cash during the fall and winter to build inventory of supplies and repair equipment. It has excess cash during the fall and winter when it collects on sales from its peak season, because cash held in checking accounts earns little, if any, interest. The financial manager tries to keep cash balances low and to invest the surplus cash. Surpluses are invested temporarily in marketable securities, short-term investments that are easily converted into cash. The financial manager looks for low-risk investments that offer high returns. Some of the most popular marketable securities are stocks, bonds, ETFs, and commercial paper. Commercial paper is a promissory note, an IOU, a short-term debt to finance short-term needs issued typically by large corporations. Today's financial managers have new tools to help them find the best short-term investments, such as online trading platforms that save time and provide access to more types of investments. These have been especially useful for smaller companies who don't have large finance staffs. Firms with operations overseas may have different and additional cash management challenges. Developing the systems for international cash management may sound simple in theory, but in practice, it's extremely complex. In addition to exchange rate fluctuations when dealing with foreign currencies, other countries have different legal, banking, regulatory, and tax requirements that need to be considered. Financial and accounting procedures need to be tailored to the requirements in the country. Local managers need to be trained on the differences and how to facilitate cross-border compliance. Financial managers should also be sensitive to local customs and business practices and adjust their approach as needed. In addition to seeking the right balance between cash and marketable securities, the financial manager tries to shorten the time between the purchase of inventory or services, cash outflows, and the collection of cash from sales, cash inflows. The three key strategies are to collect money owed to the firm, accounts receivable, to pay money owed to others, accounts payable, as late as possible without damaging the firm's credit reputation, and to minimize the funds tied up in inventory. Managing accounts receivable. Accounts receivable represent sales for which the firm has not yet been paid. Because the product has been sold, but cash has not yet been received, an account receivable amounts to a use of funds. For manufacturing firms, for example, accounts receivable represent between 12 and 18% of revenue. The financial manager's goal is to collect money owed to the firm as quickly as possible, while offering customers credit terms attractive enough to increase sales. Accounts receivable management involves setting credit policies, guidelines on offering credit, credit terms, and specific repayment conditions, including how long customers have to pay their bills and whether a cash discount is given for quicker payment. Another aspect of accounts receivable management is deciding on collection policies, the procedures for collecting overdue accounts. Setting up credit and collection policies is a balancing act for financial managers. On the one hand, easier credit policies or generous credit terms, a longer repayment period or larger cash discount result in increased sales. On the other hand, the firm has to finance more accounts receivable. The risk of uncollectible accounts receivable also rises. Businesses consider the impact on sales, timing of cash flow, experience with bad debt, customer profiles, and industry standards when developing their credit and collection policies. Companies that want to speed up collections actively manage their accounts receivable rather than passively letting customers pay when they want to. According to reports, more than 90% of businesses experience late payments from customers. And some companies write off a percentage of their bad debt, which can be expensive. Technology plays a big role in helping companies improve their credit and collections performance. For example, technologies such as AI integration to aid with decision-making and ERP systems can help companies make strategic decisions when it comes to credit and collection processes. Some companies choose to outsource financial and accounting processes rather than to invest in their own systems. Because of the pace of change in technology, it can be more cost-effective to outsource. There is still a need for a CFO, even though some control over the processes shifts to a third party. There is some risk associated with this approach, as confidential corporate data are housed on an outside network. Cybersecurity concerns are a consideration when outsourcing these functions. Another outsourcing area that firms utilize is in the international trade arena. Regulations can differ from country to country, so having an expert assist with navigating tasks such as customs clearance, trade compliance for imports and exports, and shipping logistics can be very beneficial and cost-effective. Processing costs for imported goods are often higher than those of domestic goods. So managing international commerce activities through a third party can make the transactions more efficient from both a time and money perspective. Inventory. Another use of funds is to buy inventory needed by the firm. In a typical manufacturing firm, inventory is between 20 and 25% of total assets. The cost of inventory includes not only its purchase price, but also ordering, handling, storage, interest, and insurance costs. Production, marketing, and finance managers usually have differing views about inventory. Production managers want lots of raw materials on hand to avoid production delays. Marketing managers want lots of finished goods on hand so customer orders can be filled quickly. But financial managers want the least inventory possible without harming production efficiency or sales. Financial managers must work closely with production and marketing to balance these conflicting goals. Techniques for reducing the investment in inventory are inventory management, the just-in-time system, and materials requirement planning. For retail firms, inventory management is a critical area for financial managers who closely monitor inventory turnover ratios. This ratio shows how quickly inventory moves through the firm and is turned into sales. If the inventory number is too high, it will typically affect the amount of working capital a company has on hand, forcing the company to borrow money to cover the excess inventory. If the turnover ratio number is too high, it means the company does not have enough inventory of products on hand to satisfy customer needs, which means they could take their business elsewhere. Long-term expenditures. A firm also invests funds in physical assets, such as land, buildings, machinery, equipment, and information systems. These are called capital expenditures. Unlike operating expenses, which produce benefits within a year, the benefits from capital expenditures extend beyond 1 year. For instance, a printer's purchase of a new printing press with a usable life of 7 years is a capital expenditure and appears as a fixed asset on the firm's balance sheet. Paper, ink, and other supplies, however, are expenses. Mergers and acquisitions are also considered capital expenditures. Firms make capital expenditures for many reasons. The most common are to expand, to replace or renew fixed assets, and to develop new products. Most manufacturing firms have a big investment in long-term assets. Boeing, for instance, puts billions of dollars a year into airplane manufacturing facilities because capital expenditures tend to be costly and have a major effect on the firm's future. The financial manager uses a process called capital budgeting to analyze long-term projects and select those that offer the best returns while maximizing the firm's value. Decisions involving new products or the acquisition of another business are especially important. Managers look at project costs and forecast the future benefits the project will bring to calculate the firm's estimated return on the investment.
Concept check. 1. Distinguish between short and long-term expenses. 2. What is the financial manager's goal in cash management? List the 3 key cash management strategies. 3. Describe a firm's main motives in making capital expenditures.
.3 Obtaining short-term financing. Learning objective. What are the main sources and costs of unsecured and secured short-term financing?
How do firms raise the funding they need? They borrow money, debt, sell ownership shares, equity, and retain earnings, profits. The financial manager must assess all these sources and choose the combination most likely to help maximize the firm's value. Like expenses, borrowed funds can be divided into short and long-term loans. A short-term loan comes due within 1 year. A long-term loan has a maturity greater than 1 year. Short-term financing is shown as a current liability on the balance sheet and is used to finance current assets and support operations. Short-term loans can be unsecured or secured. Unsecured short-term loans. Unsecured loans are made on the basis of the firm's creditworthiness and the lender's previous experience with the firm. An unsecured borrower does not have to pledge specific assets as security. The 3 main types of unsecured short-term loans are trade credit, bank loans, and commercial paper. Trade credit. Accounts payable. When Goodyear sells tires to General Motors, GM does not have to pay cash on delivery. Instead, Goodyear regularly bills GM for its tire purchases, and GM pays at a later date. This is an example of trade credit. The seller extends credit to the buyer between the time the buyer receives the goods or services and when it pays for them. Trade credit is a major source of short-term business financing. The buyer enters the credit on its books as an account payable. In effect, the credit is a short-term loan from the seller to the buyer of the goods and services. Until GM pays Goodyear, Goodyear has an account receivable from GM, and GM has an account payable to Goodyear. Bank loans. Unsecured bank loans are another source of short-term business financing. Companies often use these loans to finance seasonal, cyclical businesses. Unsecured bank loans include lines of credit and revolving credit agreements. A line of credit specifies the maximum amount of unsecured short-term borrowing the bank will allow the firm over a given period, typically 1 year. The firm is charged a fee in the form of interest that is based on the balance owed. Another bank loan, the revolving credit agreement, is basically a guaranteed line of credit that carries an extra fee in addition to interest. Revolving credit agreements are often arranged for a period of 2 to 5 years. Commercial paper. As noted earlier, commercial paper is an unsecured short-term debt, an IOU, issued by a financially strong corporation. Thus, it is both a short-term investment and a financing option for major corporations. Corporations issue commercial paper in multiples of $100,000 for periods ranging from 3 to 270 days. Many big companies use commercial paper instead of short-term bank loans because the interest rate on commercial paper is usually 1 to 3% below bank rates. Secured short-term loans. Secured loans require the borrower to pledge specific assets as collateral, or security. The secured lender can legally take the collateral if the borrower doesn't repay the loan. Commercial banks and commercial finance companies are the main sources of secured short-term loans to business. Borrowers whose credit is not strong enough to qualify for unsecured loans use these loans. Typically, the collateral for secured short-term loans is accounts receivable or inventory. Because accounts receivable are normally quite liquid, easily converted to cash, they are an attractive form of collateral. The appeal of inventory, raw materials or finished goods, as collateral depends on how easily it can be sold at a fair price. Another form of short-term financing using accounts receivable is factoring. A firm sells its accounts receivable outright to a factor, a financial institution, often a commercial bank or commercial finance company, that buys accounts receivable at a discount. Factoring is widely used in the clothing, furniture, and appliance industries. Factoring is more expensive than a bank loan, however, because the factor buys the receivables at a discount from their actual value.
Concept check. 1. Distinguish between unsecured and secured short-term loans. 2. Briefly describe the three main types of unsecured short-term loans. 3. Discuss the two ways that accounts receivable can be used to obtain short-term financing.
.4 Raising long-term financing. Learning objective. What are the key differences between debt and equity, and what are the major types and features of long-term debt?
A basic principle of finance is to match the term of the financing to the period over which benefits are expected to be received from the associated outlay. Short-term items should be financed with short-term funds, and long-term items should be financed with long-term funds. Long-term financing sources include both debt, borrowing, and equity, ownership. Equity financing comes either from selling new ownership interests or from retaining earnings. Financial managers try to select the mix of long-term debt and equity that results in the best balance between cost and risk. Debt versus equity financing. Say that Boeing plans to spend $2 billion over the next 4 years to build and equip new factories to make jet aircraft. Boeing's top management will assess the pros and cons of both debt and equity, and then consider several possible sources of the desired form of long-term financing. The major advantage of debt financing is the deductibility of interest expense for income tax purposes, which lowers its overall cost. In addition, there is no loss of ownership. The major drawback is financial risk, the chance that the firm will be unable to make scheduled interest and principal payments. The lender can force a borrower that fails to make scheduled debt payments into bankruptcy. Most loan agreements have restrictions to ensure that the borrower operates efficiently. Equity, on the other hand, is a form of permanent financing that places few restrictions on the firm. The firm is not required to pay dividends or repay the investment. However, equity financing gives common stockholders voting rights that provide them with a voice in management. Equity is more costly than debt. Unlike the interest on debt, dividends to owners are not tax-deductible expenses. Table 16.1 summarizes the major differences between debt and equity financing.
Table 16.1. Major differences between debt and equity financing. There are four major areas of comparison between debt financing and equity financing: management influence, rights to income and assets, maturity dates, and tax treatment. Having a say in management. Under debt financing, creditors typically have none unless the borrower defaults on payments. Creditors may be able to place restraints on management in the event of default. Under equity financing, common stockholders have voting rights. Right to income and assets. With debt financing, debt holders rank ahead of equity holders. Payment of interest and principal is a contractual obligation of the firm. With equity financing, equity owners have a residual claim on income, meaning dividends are paid only after paying interest and any scheduled principal, and the firm has no obligation to pay dividends. Maturity. For debt financing, debt has a stated maturity and requires repayment of principal by a specified date. For equity financing, the company is not required to repay equity, which has no maturity date. Tax treatment. Under debt financing, interest is a tax-deductible expense. Under equity financing, dividends are not tax-deductible and are paid from after-tax income.
Debt financing. Long-term debt is used to finance long-term capital expenditures. Debt maturity for long-term debt can range from more than a year to as long as 30 years, depending on the type of debt. Three forms of long-term debt utilized by corporations include term loans, bonds, and mortgage loans. A term loan is a business loan with a maturity of more than 1 year. Term loan maturities can vary between 3 to 25 years and can be unsecured or secured. They are available from commercial banks, insurance companies, pension funds, commercial finance companies, and manufacturers' financing subsidiaries. A contract between the borrower and the lender spells out the amount and maturity of the loan, the interest rate payment dates, the purpose of the loan, and other provisions, such as operating and financial restrictions on the borrower, to control the risk of default. The payments include both interest and principal, so the loan balance declines over time. Borrowers try to arrange a repayment schedule that matches the forecast cash flow from the project being financed. Bonds are long-term debt obligations, liabilities of corporations and governments. A bond certificate is issued as proof of the obligation. The issuer of a bond must pay the buyer a fixed amount of money, called interest, stated as the coupon rate, on a regular schedule, typically every 6 months. The issuer must also pay the bondholder the amount borrowed, called the principal or par value, at the bond's maturity date, due date. Bonds are usually issued in units of $1,000. For instance, $1,000, $5,000, or $10,000, and typically have an initial maturity length of 10 to 30 years. They may be secured or unsecured, include special provisions for early retirement, or be convertible to common stock. A mortgage loan is a long-term loan made against real estate as collateral. The lender takes a mortgage on the property, which lets the lender seize the property, sell it, and use the proceeds to pay off the loan if the borrower fails to make the scheduled payments. Long-term mortgage loans are often used to finance office buildings, factories, and warehouses. Life insurance companies are an important source of these loans. They make billions of dollars worth of mortgage loans to businesses each year.
Concept check. 1. Distinguish between debt and equity. 2. Identify the major types and features of long-term debt.
(16.5) Equity financing. Learning objective. When and how do firms issue equity, and what are the costs?
Equity refers to the owner's investment in the business. In corporations, the preferred and common stockholders are the owners. A firm obtains equity financing by selling new ownership shares, external financing, by retaining earnings, internal financing, or for small and growing, typically high-tech companies, through venture capital, external financing. Selling new issues of common stock. Common stock is a security that represents an ownership interest in a corporation. A company's first sale of stock to the public is called an initial public offering, IPO. An IPO often enables existing stockholders, usually employees, family, and friends, who bought the stock privately to earn big profits on their investment. Companies that are already public can issue and sell additional shares of common stock to raise equity funds. But going public has some drawbacks. For one thing, there's no guarantee an IPO will sell. It is also expensive. Big fees must be paid to investment bankers, brokers, attorneys, and accountants. Once the company is public, it is closely watched by regulators, stockholders, and securities analysts. The firm must reveal such information as operating and financial data, product details, financing plans, and operating strategies. Providing this information is often costly. Going public is the dream of many small company founders and early investors who hope to recoup their investments and have their company become profitable. Intuitive Surgical went public in 2000, trading at just $2 per share. Now, over 2 decades later, the stock is trading at nearly $500 per share. The company specializes in robotic systems for minimally invasive surgeries. And as the technology has been adopted at over 6,000 hospitals in the United States, the stock has steadily grown. The number of IPOs can vary based on economic and political conditions, and the decision requires planning and strategic moves, despite the expected lucrative rewards for both investors and entrepreneurs. For example, in 2014, King Digital Entertainment, a mobile game creator, had its IPO with the stock opening at $20.50. By the end of the first day of trading, the stock had dropped over 15%, and by the end of the first year, it was down 23%. The business was eventually acquired by Activision Blizzard in 2016. The decline was attributed to the decreasing popularity of its key game, Candy Crush Saga, and investors became skeptical that the company was too reliant on a single product. Some companies choose to remain private. Cargill, Public Supermarkets, Mars, and Fidelity Investments are among the largest U.S. private companies. Dividends and retained earnings. Dividends are payments to stockholders from a corporation's profits. Dividends can be paid in cash or in stock. Stock dividends are payments in the form of more stock. Stock dividends may replace or supplement cash dividends. After a stock dividend has been paid, more shares have a claim on the same company, so the value of each share often declines. A company does not have to pay dividends to stockholders. But if investors buy the stock expecting to get dividends and the firm does not pay them, the investors may sell their stocks. At their meetings, a company's board of directors will review proposals from the firm's management to determine how much to distribute as dividends. A firm's basic approach to paying dividends can greatly affect its share price. A stable history of dividend payments indicates good financial health. For example, pharmaceutical company Eli Lilly & Co. has increased its dividend for the last 11 years, with a growth rate of over 15%, giving shareholders a solid return on their investment. If a firm that has been making regular dividend payments cuts or skips a dividend, investors start thinking it has serious financial problems. The increased uncertainty often results in lower stock prices. Thus, most firms set dividends at a level they can keep paying. They start with a relatively low dividend payout ratio so that they can maintain a steady or slightly increasing dividend over time. Retained earnings, profits that have been reinvested in the firm, have a big advantage over other sources of equity capital. They do not incur underwriting costs. Financial managers strive to balance dividends and retained earnings to maximize the value of the firm. Often, the balance reflects the nature of the firm and its industry. Mature firms with management confidence for positive earnings in the future, such as construction materials firms, companies in the oil and gas sector, consumer goods businesses, and financial services companies, typically pay out a good portion of their earnings in dividends. For example, in the 2025 fiscal year, ExxonMobil paid dividends of $4.12 per share. Altria Group paid $4.24 per share. Apple paid $1.04 per share. And Costco paid $5.20 per share. Some high-growth companies, or those yet to have a profit, such as those in technology-related sectors, finance their company growth through their retained earnings and do not pay out dividends. As the firm matures, some then decide to begin paying dividends, as Dell decided to do in 2022 after being publicly traded for 34 years. Preferred stock. Another form of equity is preferred stock. Unlike common stock, preferred stock usually has a dividend amount that is set at the time the stock is issued. These dividends must be paid before the company can pay any dividends to common stockholders. Also, if the firm goes bankrupt and sells its assets, preferred stockholders get their money back before common stockholders do. Like debt, preferred stock increases the firm's financial risk because it obligates the firm to make a fixed payment, but preferred stock is more flexible. The firm can miss a dividend payment without suffering the serious results of failing to pay back a debt. Preferred stock is more expensive than debt financing. However, because preferred dividends are not tax deductible. Also, because the claims of preferred stockholders on income and assets are second to those of debt holders, preferred stockholders require higher returns to compensate for the greater risk. Venture capital. Venture capital is another source of equity capital. It is most often used by small and growing firms that aren't big enough to sell securities to the public. This type of financing is especially popular among high-tech firms in sectors such as fintech, biotechnology, and robotics that need significant seed money to finance their operations. Venture capitalists invest in new businesses in return for part of the ownership, typically between 20 and 40%. They look for business with high return on investment potential. The time frame required for the venture capitalist to see a return varies by the industry and the stage of the business. However, typically returns are realized in 12 to 14 years. By getting in on the ground floor, venture capitalists buy stock at a very low price. They earn profits by selling the stock at a much higher price when the company goes public. Venture capitalists generally get a voice in management through seats on the board of directors. Getting venture capital is difficult, even though there are hundreds of private venture capital firms in this country. Only about 1% of companies that apply for venture capital funding are financed. Venture capital investors are strategic when deciding which firms to finance, weighing the risks of the business and economic risks against the probability of getting a large enough return to justify the risk level. In addition to venture capital, other sources of funding, including private foundations, states, and wealthy individuals, called angel investors, are helping startup firms find equity capital. These private investors are motivated by the potential to earn a high return on their investment.
Concept check. 1. Compare the advantages and disadvantages of debt and equity financing. 2. Discuss the costs involved in issuing common stock. 3. Briefly describe these sources of equity: retained earnings, preferred stock, and venture capital.
(16.6) Securities Markets. Learning objective. How do securities markets help firms raise funding? And what securities trade in the capital markets?
Stocks, bonds, and other securities trade in securities markets. These markets streamline the purchase and sales activities of investors by allowing transactions to be made quickly and at a fair price. Securities are investment certificates that represent either equity, ownership in the issuing organization, or debt, a loan to the issuer. Corporations and governments raise capital to finance operations and expansion by selling securities to investors, who in turn take on a certain amount of risk with the hope of receiving a profit from their investment. Securities markets are busy places. On an average day, individual and institutional investors trade billions of shares of stock in more than 10,000 companies through securities markets. Individual investors invest their own money to achieve their personal financial goals. Institutional investors are investment professionals who are paid to manage other people's money. Most of these professional money managers work for financial institutions, such as banks, mutual funds, insurance companies, and pension funds. Institutional investors control very large sums of money, often buying stock in 10,000 share blocks. They aim to meet the investment goals of their clients. Institutional investors are a major force in the securities markets, accounting for about half of the dollar volume of equities traded. Types of markets. Securities markets can be divided into primary and secondary markets. The primary market is where new securities are sold to the public, usually with the help of investment bankers. In the primary market, the issuer of the security gets the proceeds from the transaction. A security is sold in the primary market just once, when the corporation or government first issues it. King Digital Entertainment is an example of a primary market offering. Later transactions take place in the secondary market, where old, already issued securities are bought and sold or traded among investors. The issuers generally are not involved in these transactions. The vast majority of securities transactions take place in secondary markets, which include broker markets, dealer markets, the over-the-counter market, and the commodities exchanges. You'll see tombstones, announcements of both primary and secondary stock and bond offerings, in the Wall Street Journal and other news sources. The role of investment bankers and stockbrokers. Two types of investment specialists play key roles in the functioning of the securities markets. Investment bankers help companies raise long-term financing. These firms act as intermediaries, buying securities from corporations and governments and reselling them to the public. This process, called underwriting, is the main activity of the investment banker, which acquires the security for an agreed-upon price and hopes to be able to resell it at a higher price to make a profit. Investment bankers advise clients on the pricing and structure of new securities offerings, as well as on mergers, acquisitions, and other types of financing. Well-known investment banking firms include Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America Merrill Lynch, and Citigroup. A stockbroker is a person who is licensed to buy and sell securities on behalf of clients. Also called account executives, these investment professionals work for brokerage firms and execute the orders customers place for stocks, bonds, mutual funds, and other securities. Investors are wise to seek a broker who understands their investment goals and can help them pursue their objectives. Brokerage firms are paid commissions for executing clients' transactions. Typically, most brokerage firms have fixed commission schedules for transactions. These commissions usually depend on the value of the transaction and the number of shares involved. Online investing. Technological advances have made it commonplace for investors to research, analyze, and trade securities online. Today, almost all brokerage firms offer online trading capabilities. Online brokerages are popular with do-it-yourself investors who choose their own stocks and don't want to pay a full-service broker for these services. Lower transaction costs are a major benefit. Fees at online or app brokerages are often low, and many offer zero trading fees for standard stock transactions, with some minimal fees for more complex services. Although there are many online brokerage firms, the four largest, Charles Schwab, Fidelity, Vanguard, and JP Morgan Chase, have digital customers that account for nearly 70% of all brokerage clients and trillions in assets. The internet also offers investors access to a wealth of investment information.
Managing change. Competition causes online fees to drop. With the U.S. stock market routinely setting new all-time record highs, private investors are increasingly interested in getting into the market on their own. Historically, trading stocks meant high fees paid to brokers to execute the transactions. Technological advances have provided private investors an alternative through online or app-based trading platforms. These platforms are offered by traditional brick-and-mortar firms, such as Fidelity, Charles Schwab, TD Ameritrade, and E-Trade, and through independent apps such as Robinhood. With advances in technology, including the use of artificial intelligence, the costs associated with handling stock trades has dropped dramatically over the last decade. and investors are looking for the best possible deal. With competition from companies such as Robinhood, a startup app that offers $0 fees for stock trades, online trading firms have rushed to reduce their fees to attract more overall business. Fidelity, Charles Schwab, TD Ameritrade, and E-Trade eliminated their fees for many transactions in order to compete with apps like Robinhood. So how will these firms continue to make money? They believe that lowering the price of entry for trading stocks will allow them to sweep up customer assets, meaning firms have an opportunity to attract new customers who not only will take advantage of low trading fees, but will be interested in other financial products offered by these investment companies. Other services offered by online trading firms include providing loans to purchase stock and selling customers additional features such as wealth management or stock research services. According to some industry analysts, one downside to matching competitors' low fees could be a strategy of consolidation within the online trading industry. Unless firms can increase their overall business by reaching out to current customers and potential ones, some may be forced to join up with competitors. Critical thinking questions. 1. From a business standpoint, do you think the almost free trading fees make sense? Explain. 2. What can online trading firms do to increase their overall business, particularly when it comes to attracting new investors?
Investing in bonds. When many people think of financial markets, they picture the equity markets. However, the bond markets are huge. The International Capital Markets Association, ICMA, estimates that the global bond market was over $123 trillion in 2020. The global bond market had grown to approximately $141 trillion in 2024. Average daily trading volume exceeded $1.07 trillion in 2024, with the U.S. Treasury securities accounting for over 40% of the total. Bonds can be bought and sold in the securities markets. However, the price of a bond changes over its life as market interest rates fluctuate. When the market interest rate drops below the fixed interest rate on a bond, it becomes more valuable and the price rises. If interest rates rise, the bond's price will fall. Corporate bonds, as the name implies, are issued by corporations. They usually have a par value of $1,000. They may be secured or unsecured, called debentures, include special provisions for early retirement, or be convertible to common stock. Corporations can also issue mortgage bonds, bonds secured by property such as land, buildings, or equipment. Approximately $1.5 trillion in new corporate bonds were issued in 2025. In addition to regular corporate debt issues, investors can buy high-yield bonds, also called junk bonds. High-risk, high-return bonds often used by companies whose credit characteristics would not otherwise allow them access to the debt markets. They generally earn 4 to 5% above the returns on high-quality corporate bonds. Corporate bonds may also be issued with an option for the bondholder to convert them into common stock. These convertible bonds generally allow the bondholder to exchange each bond for a specified number of shares of common stock. U.S. government securities and municipal bonds. Both the federal government and local government agencies also issue bonds. The U.S. Treasury sells 3 major types of federal debt securities: Treasury bills, Treasury notes, and Treasury bonds. All 3 are viewed as default risk-free because they are backed by the U.S. government. Treasury bills mature in 1 year or less. Treasury notes have maturities of 2 to 10 years, and Treasury bonds have maturities as long as 20 or 30 years. All 3 are sold in increments of $100 with a minimum purchase of $100. The interest earned on government securities is subject to federal income tax, but is free from state and local income taxes. According to SIFMA, just under $30 trillion in U.S. Treasuries were issued in 2025, up nearly 30% from 2023. Municipal bonds are issued by states, cities, counties, and other state and local government agencies. Over $580 billion in municipal bonds were issued in 2025. These bonds typically have a par value of $5,000 and are either general obligation, or revenue bonds. General obligation bonds are backed by the full faith and credit and taxing power of the issuing government. Revenue bonds, on the other hand, are repaid only from income generated by the specific project being financed. Examples of revenue bond projects include toll highways and bridges, stadiums, and parking structures. Because the issuer of revenue bonds has no legal obligation to back the bonds if the project's revenues are inadequate, they are considered more risky and therefore have higher interest rates than general obligation bonds. Municipal bonds are attractive to investors because interest earned on them is typically exempt from federal income tax. For the same reason, the coupon interest rate for a municipal bond is lower than for a similar quality corporate bond. In addition, interest earned on municipal bonds issued by governments within the taxpayer's home state is exempt from state income tax as well. In contrast, all interest earned on corporate bonds is fully taxable. Bond ratings. Bonds vary in quality depending on the financial strength of the issuer. Because the claims of bondholders come before those of stockholders, bonds are generally considered less risky than stocks. However, some bonds are in fact quite risky. Companies can default, fail to make scheduled interest or principal payments on their bonds. Investors can use bond ratings, letter grades assigned to bond issues, to indicate their quality or level of risk. Ratings for corporate bonds are easy to find. The most well-known rating agencies are Moody's, Standard & Poor's, S&P, and Fitch, whose publications with ratings are found readily online. Table 16.2 lists the letter grades assigned by the agencies. A bond's rating may change if a company's financial condition changes.
Table 16.2. Moody's and Standard & Poor's bond ratings. Bond ratings fall into 5 major categories based on their credit quality and level of risk. Prime quality investment bonds. Under Moody's ratings, these are rated AAA, spelled capital A, lowercase AA. Standard & Poor's and Fitch ratings use all caps AAA, spelled capital AAA. This is the highest rating assigned and indicates an extremely strong capacity to pay. High-grade investment bonds. Moody's rates these as AA, spelled capital A, lowercase a, or single A. Standard & Poor's and Fitch rate them as all caps, AA, or single A. These are also considered very safe bonds, although not quite as safe as AAA issues. AA-rated bonds are safer, having less risk of default than single-A rated bonds. Medium-grade investment bonds. Moody's assigns a rating of BAA, spelled capital B, lowercase AA, while Standard & Poor's and Fitch assign an all caps rating of BBB. These are the lowest of the investment grade issues and are seen as lacking protection against adverse economic conditions. Junk bonds. Moody's rates these as BA, spelled capital B, lowercase a, or single B. Standard & Poor's and Fitch use all caps double B or single B. They provide little protection against default and are viewed as highly speculative. Poor quality bonds. Moody's assigns ratings of CAA, spelled capital C, lowercase AA, CA, spelled capital C, lowercase a, or single C. Standard & Poor's and Fitch assign all caps, triple C, double C, single C, or D. These bonds are either in default or very close to it.
Other popular securities. In addition to stocks and bonds, investors can buy mutual funds, a very popular investment category, or exchange-traded funds, ETFs. Futures contracts and options are more complex investments for experienced investors. Mutual funds. Suppose that you have $1,000 to invest. but don't know which stocks or bonds to buy, when to buy them, or when to sell them. By investing in a mutual fund, you can buy shares in a large, professionally managed portfolio or group of stocks and bonds. A mutual fund is a financial service company that pools its investors' funds to buy a selection of securities, marketable securities, stocks, bonds, or a combination of securities that meet its stated investment goals. Each mutual fund focuses on one of a wide variety of possible investment goals, such as growth or income. Many large financial service companies, such as Fidelity and Vanguard, sell a wide variety of mutual funds, each with a different investment goal. Investors can pick and choose funds that match their particular interests. Some mutual funds are invested in a certain type of company, industry, geographical region, or asset. For example, there are mutual funds in one industry, such as healthcare or real estate. Others might be comprised on all international funds or on only stocks that offer high dividends. Mutual funds are one of the most popular investments for individuals today. They can choose from over 8,000 different funds. Investments in mutual funds are more than $69 trillion worldwide, of which U.S. mutual funds hold more than $28 trillion, about 125 million individuals, representing over half of all U.S. households, own mutual funds. Mutual funds appeal to investors for three main reasons. They are a good way to hold a diversified and thus less risky portfolio. Investors with only $500 or $1,000 to invest cannot diversify much on their own. Buying shares in a mutual fund lets them own part of a portfolio that may contain 100 or more securities. Mutual funds are professionally managed. Mutual funds may offer higher returns than individual investors could achieve on their own. Exchange-traded funds. Another type of investment, the exchange-traded fund, ETF, has become very popular with investors. ETFs are similar to mutual funds because they hold a broad basket of stocks with a common theme, giving investors instant diversification. ETFs trade on stock exchanges. Most trade on the New York Stock Exchange, NYSE. So their prices change throughout the day, whereas mutual fund share prices, called net asset values, NAVs, are calculated once a day at the end of trading. Worldwide, ETF assets in 2025 were almost $20 trillion, with the US ETF market accounting for nearly 70% of the global market. Investors can choose from more than 12,000 global and about 3,500 EFTs in the United States that track almost any market sector. From a broad market index, such as the S&P 500, described later in this chapter, industry sectors such as healthcare or energy, and geographical areas such as a particular country, Japan, or region, Southeast Asia. ETFs have very low expense ratios. However, because they trade as stocks, investors pay commissions to buy and sell these shares. Futures, contracts, and options. Futures contracts are legally binding obligations to buy or sell specified quantities of commodities, agricultural or mining products, or financial instruments, securities, or currencies, at an agreed-on price at a future date. An investor can buy commodity futures contracts in corn, soybeans, coffee, wheat, oil, or lumber, as just a few examples. Financial futures include treasury securities and foreign currencies, such as the euro or Japanese yen. Futures contracts do not pay interest or dividends. The return depends solely on favorable price changes. These are very risky investments because the prices can vary a great deal. Options are contracts that entitle holders to buy or sell specified quantities of common stocks or other financial instruments at a set price during a specified time. As with futures contracts, investors must correctly guess future price movements in the underlying financial instrument to earn a positive return. Unlike futures contracts, options do not legally obligate the holder to buy or sell, and the price paid for an option is the maximum amount that can be lost. However, options have very short maturities, so it is easy to quickly lose a lot of money with them.
Concept check. 1. Distinguish between primary and secondary securities markets. How does an investment banker work with companies to issue securities? 2. Describe the types of bonds available to investors and the advantages and disadvantages they offer. 3. Why do mutual funds and exchange-traded funds appeal to investors? Discuss why futures contracts and options are risky investments.
Sixteen point seven. Buying and selling at securities exchanges. Learning objective. Where can investors buy and sell securities, and how are securities markets regulated?
When we think of stock markets, we are typically referring to secondary markets, which handle most of the securities trading activity. The two segments of the secondary markets are broker markets and dealer markets, as Exhibit 16.6 shows. The primary difference between broker and dealer markets is the way each executes securities trades. Securities trades can also take place in alternative market systems and on non-US securities exchanges. The securities markets, both in the United States and around the world, are in flux and undergoing tremendous changes. We present the basics of securities exchanges in this section and discuss the latest trends in the global securities markets later in the chapter. Broker markets. The broker market consists of national and regional securities exchanges that bring buyers and sellers together through brokers on a centralized trading floor. In the broker market, the buyer purchases the securities directly from the seller through the broker. Broker markets account for about 60% of the total dollar volume of all shares traded in the U.S. securities markets.
Exhibit 16.6. The secondary markets, broker and dealer markets. Secondary markets are divided into two main categories: broker markets and dealer markets. Broker markets. Broker markets consist of two types of exchanges: national exchanges and regional exchanges. National exchanges include the New York Stock Exchange and the American Stock Exchange. Regional exchanges include Boston, Chicago, National, and Philadelphia. Dealer markets. Dealer markets are split between NASDAQ and over-the-counter, or OTC, markets. NASDAQ includes three tiers: the NASDAQ Global Select Market, the NASDAQ National Market, and the NASDAQ Capital Market. The OTC market includes the OTC Bulletin Board, or OTC BBB, and Pink Sheets.
New York Stock Exchange. The oldest and most prestigious broker market is the New York Stock Exchange, NYSE, which has existed since 1792. Often called the Big Board, it is located on Wall Street in downtown New York City. The NYSE, which lists the shares of 2,800 companies, had a total market capitalization, domestic and foreign companies, of $44 trillion in January 2026. On a typical day, more than 1.46 billion shares of stock are traded on the NYSE. It represents about half of the trading volume in the U.S. broker marketplace. Major companies such as Verizon, Home Depot, Procter & Gamble, Reddit, Uber, and Nike list their shares on the NYSE. Companies that list on the NYSE must meet stringent listing requirements and annual maintenance requirements, which give them credibility. The NYSE is also popular with non-US companies. More than 520 international companies with a market value in the trillions now list their securities on the NYSE. In the past, all NYSE transactions occurred on the vast NYSE trading floor. Each of the companies traded at the NYSE is assigned to a trading post on the floor. When an exchange member receives an order to buy or sell a particular stock, the order is transmitted to a floor broker at the company's trading post. The floor brokers then compete with other brokers on the trading floor to get the best price for their customers. In response to competitive pressures from electronic exchanges, the NYSE created a hybrid market that combines features of the floor auction market and automated trading. Its customers now have a choice of how they execute trades. Trends and changes to the NYSE as technology has advanced will be discussed later in the chapter. Another national stock exchange, NYSE American, formerly the American Stock Exchange, AMEX, lists the securities of 238 corporations in an electronic platform. Because the rules of this exchange are less strict than those of the NYSE, many listed firms are new, entrepreneurial ventures less well known than the NYSE listed corporations. The firms typically are smaller cap stocks that trade at much lower volumes. Some firms choose to move up to the NYSE once they qualify, but they can choose to remain listed on the NYSE American. The NYSE American Exchange has become a major exchange for EFTs and small cap companies. Dealer markets. Unlike broker markets, dealer markets do not operate on centralized trading floors, but instead use sophisticated telecommunications networks that link dealers throughout the United States. Buyers and sellers do not trade securities directly, as they do in broker markets. They work through securities dealers called market makers, who make markets in one or more securities and offer to buy or sell securities at stated prices. A security transaction in the dealer market has two parts. The selling investor sells their securities to one dealer, and the buyer purchases the securities from another dealer, or in some cases, the same dealer. NASDAQ. The largest dealer market is the National Association of Securities Dealers Automated Quotation System, commonly referred to as NASDAQ. The first electronic-based stock market, the NASDAQ, is a global, sophisticated electronic marketplace that links dealers throughout the United States. Founded in 1971, with origins in the over-the-counter OTC market, today NASDAQ is a separate securities exchange that is no longer part of the OTC market. The NASDAQ lists more companies than the NYSEs, but the NYSE still leads in total market capitalization. Between 8 billion to over 10 billion shares are exchanged daily in 2026 through NASDAQ, and it is the world's largest electronic exchange. It provides up-to-date bid and ask prices on about 3,500 of the most active OTC securities. Its sophisticated electronic communication system provides faster transaction speeds than traditional floor markets and is the main reason for the popularity and growth of the OTC market. In January 2006, the SEC approved NASDAQ's application to operate as a national securities exchange. As a result, the NASDAQ Stock Market LLC began operating independently in August 2006. The securities of many well-known companies, some of which could be listed on the organized exchanges, trade on the NASDAQ. Examples include Amazon, Alphabet, Costco, Comcast, Honeywell, and Starbucks. The stocks of most commercial banks and insurance companies also trade in this market, as do most government and corporate bonds. More than 1,400 foreign companies also trade on the NASDAQ. More than a decade ago, the NASDAQ changed its structure to a three-tier market. The NASDAQ Global Select Market, a new tier with financial and liquidity requirements that are higher than those of any other market, according to NASDAQ. More than 1,300 NASDAQ companies qualify for this group. The NASDAQ Global Market, formerly the NASDAQ National Market, which will list about 1,350 companies. The NASDAQ Capital Market will replace the NASDAQ Small Cap Market and list about 1,300 companies. All three market tiers adhere to NASDAQ's rigorous listing and corporate governance standards. The over-the-counter market. The over-the-counter OTC markets refer to those other than the organized exchanges described above. There are three OTC markets: Pink Sheets, OTCQX, and OTCQB. These markets generally list small companies and have no listing or maintenance standards, making them attractive to young companies looking for funding. OTC companies do not have to file with the SEC or follow the costly provisions of Sarbanes-Oxley. Investing in OTC companies is therefore highly risky and should be for experienced investors only. Alternative trading systems. In addition to broker and dealer markets, alternative trading systems such as electronic communications networks, ECNs, make securities transactions. ECNs are private trading networks that allow institutional traders and some individuals to make direct transactions in what is called the fourth market. ECNs bypass brokers and dealers to automatically match electronic buy and sell orders. They are most effective for high volume, actively traded stocks. Money managers and institutions, such as pension funds and mutual funds, with large amounts of money to invest like ECNs because they cost far less than other trading venues. Global trading and foreign exchanges. Improved communications and the elimination of many legal barriers are helping the securities markets go global. The number of securities listed on exchanges in more than one country is growing. Foreign securities are now traded in the United States. Likewise, foreign investors can easily buy U.S. securities. Stock markets also exist in foreign countries. Over 70 major countries operate their own securities exchanges. NASDAQ ranks second to the NYSE, followed by Shanghai and the Japan/Tokyo Stock Exchange. Other important foreign stock exchanges include Euronext, which merged with the NYSE but operates separately, Toronto, London, National India, Shenzhen, China, and Korea. The number of big U.S. corporations with listings on foreign exchanges is growing steadily, especially in Europe. For example, significant activity in NYSE-listed stocks also occurs on the LSE. The LSE also is getting a growing share of the world's IPOs. Emerging markets, such as India, whose economy has been growing 6% or more a year, continue to attract investor attention. The Sensex, the benchmark index of the Bombay Stock Exchange, increased nearly 80% since 2020 as foreign investors continue to put money into Indian stocks and the world's economies recover from the COVID-19 pandemic. Why should U.S. investors pay attention to international stock markets? Because the world's economies are increasingly interdependent, businesses must look beyond their own national borders to find materials to make their goods and markets for foreign goods and services. The same is true for investors, who may find that they can earn higher returns in international markets. Regulation of securities markets. Both state and federal governments regulate the securities markets. The states were the first to pass laws aimed at preventing securities fraud. But most securities transactions occur across state lines, so federal securities laws are more effective. In addition to legislation, the industry has self-regulatory groups and measures. Securities legislation. Congress passed the Securities Act of 1933 in response to the 1929 stock market crash and subsequent problems during the Great Depression. It protects investors by requiring full disclosure of information about new securities issues. The issuer must file a registration statement with the SEC, which must be approved by the SEC before the security can be sold. The Securities Exchange Act of 1934 formally gave the SEC power to regulate securities exchanges. The act was amended in 1964 to give the SEC authority over the dealer markets as well. The amendment included rules for operating the stock exchanges and granted the SEC control over all participants, exchange members, brokers, dealers, and the securities traded in these markets. The 1934 Act also banned insider trading, the use of information that is not available to the general public to make profits on securities transactions. Because of lax enforcement, however, several big insider trading scandals occurred during the late 1980s. The Insider Trading and Fraud Act of 1988 greatly increased the penalties for illegal insider trading and gave the SEC more power to investigate and prosecute claims of illegal actions. The meaning of insider was expanded beyond a company's directors, employees, and their relatives to include anyone who gets private information about a company. Other important legislation includes the Investment Company Act of 1940, which gives the SEC the right to regulate the practices of investment companies, such as mutual funds managed by financial institutions. and the Investment Advisors Act of 1940, which requires investment advisors to disclose information about their background. The Securities Investor Protection Corporation, SIPC, was established in 1970 to protect customers if a brokerage firm fails by insuring each customer's account for up to $500,000. In response to corporate scandals that hurt thousands of investors, the SEC passed new regulations designed to restore public trust in the securities industry. It issued Regulation FD, for fair disclosure, in October 2000. Regulation FD requires public companies to share information with all investors at the same time, leveling the information playing field. The Sarbanes-Oxley Act of 2002 has given the SEC more power when it comes to regulating how securities are offered, sold, and marketed. Self-regulation. The investment community also regulates itself, developing and enforcing ethical standards to reduce the potential for abuses in the financial marketplace. The Financial Industry Regulatory Authority, FINRA, oversees the nation's approximately 3,500 brokerage firms and 620,000 registered brokers. It develops rules and regulations, provides a dispute resolution forum, and conducts regulatory reviews of member activities for the protection and benefit of investors. In response to Black Monday, October 19, 1987, when the Dow Jones Industrial Average plunged 508 points and the trading activity severely overloaded the exchange's computers, the securities markets instituted corrective measures to prevent a repeat of the crisis. Now, under certain conditions, circuit breakers stop trading for a 15-minute cooling-off period to limit the amount the market can drop in one day. Under revised rules, approved in 2012 by the SEC, market-wide circuit breakers kick in when the S&P 500 index drops 7%, level 1, 13%, level 2, and 20%, level 3, from the prior day's closing numbers.
Ethics in practice. Blowing the whistle on financial fraud. As part of the 2010 Dodd-Frank legislation passed by Congress in response to the 2008 financial crisis, the Securities and Exchange Commission, SEC, established a whistleblower rewards program to provide employees and other individuals with the opportunity to report financial securities misconduct. More than 7 years after starting the Office of the Whistleblower, the SEC reports that the rewards program has recovered $37 billion in financial penalties from companies that have done things to damage their own reputation, as well as those of employees and other stakeholders. According to the SEC, 2025 saw a sharp decline for individuals reporting financial wrongdoings and whistleblowers being rewarded for what they discovered. In 2025, around $60 million was awarded to whistleblowers, an amount far less than the $255 million awarded in 2024, and $600 million in 2023. Since its inception in 2011, nearly $7 billion has been awarded to individuals for their information. The whistleblower program is based on 3 key components: monetary awards, prohibition of employer retaliation, and protection of the whistleblower's identity. The program requires the SEC to pay out monetary awards to eligible individuals who voluntarily provide original information about a violation of federal securities laws that has occurred, is ongoing, or is about to take place. The information supplied must lead to a successful enforcement action or monetary sanctions exceeding $1 million. No awards are paid out until the sanctions are collected from the offending firm. A whistleblower must be an individual, not a company. And that individual does not need to be employed by a company to submit information about that specific organization. A typical award to a whistleblower is between 10 and 30% of the monetary sanctions the SEC and others, for example, the U.S. Attorney General, are able to collect from the company in question. In 2024, the whistleblower program received nearly 25,000 tips, nearly double the tips that were received in 2022. The program is not limited to U.S. citizens or residents. Foreign persons living abroad may submit tips and are eligible to receive a monetary award. In fact, in 2015, the SEC gave $104 million to a foreign national for information regarding international tax fraud. In 2020, there were about 100 whistleblowers from outside the United States. Despite criticisms from some financial institutions, the Whistleblower Rewards Program continues to be a success, reinforcing the point that financial fraud will not go unnoticed by the SEC, employees, and other individuals. Critical thinking questions. 1. Despite assurances that companies involved in financial fraud are not allowed to retaliate against their accusers, would you blow the whistle on your employer? Why or why not? 2. What can companies do to make sure their employees are aware of the consequences of financial securities fraud? Provide several examples.
Concept check. 1. How do the broker markets differ from dealer markets, and what organizations compose each of these two markets? 2. Why is the globalization of the securities markets important to U.S. investors? What are some of the other exchanges where U.S. companies can list their securities? 3. Briefly describe the key provisions of the main federal laws designed to protect securities investors. What is insider trading, and how can it be harmful? How does the securities industry regulate itself?
Sixteen point eight. Trends in financial management and securities markets. Learning objective. What are the current developments in financial management and the securities markets?
Many of the key trends shaping the practice of financial management echo those in other disciplines. For example, technology is improving the efficiency with which financial managers run their operations. In the wake of a slowing economy and corporate scandals, the SEC assumed a stronger role and implemented additional regulations to protect investors from fraud and misinformation. A wave of merger mania hit the global securities markets, as the securities exchanges themselves have begun to consolidate to capture larger shares of the world's trading volume in multiple types of securities. Online brokerage firms are seeking new ways to capture and keep their customers by broadening the services they offer and keeping the fees they charge highly competitive. Two key areas where technology is playing a role is with overseeing corporate compliance, required as a result of the Sarbanes-Oxley Act, and advances in electronic trading platforms and niche markets. Finance looks outward. No longer does finance operate in its own little world of spreadsheets and banking relationships. Most CFOs want the finance function to be viewed by their company's business units as a strategic partner who can contribute to their success. Finance professionals, therefore, need a broad view of company operations to communicate effectively with business unit managers, board members, creditors, and investors. The goal is productive cooperation and teamwork between finance and the business units. To meet corporate objectives, CFOs are more highly visible and active in company management than ever before. They serve as both business partner to the chief executive and a fiduciary to the board. As a result of accounting scandals and the Great Recession, CFOs consider accuracy of financial reporting their top priority. And they also must now provide more detailed explanations of what's behind the numbers to board members and other stakeholders. Rather than showering the board with financial reports and statistics, CFOs are crafting more focused presentations that deal with the company's overall financial health and future prospects. They must also educate board members about the implications of Sarbanes-Oxley and other legislation such as Dodd-Frank, and what the company is doing to comply with federal regulations. Vying for the crown. The NYSE and the NASDAQ continue to compete for the top spot in the global securities markets. The NYSE fell behind because the NASDAQ already had an electronic platform. This prompted the NYSE to respond with their hybrid market, in addition to changes to their organizational structure and merger with Archipelago, a major ECN. NASDAQ responded by expanding their reach by acquiring Instanet's iNet. The NYSE made the strategic move to merge with Euronext to create the first cross-border exchange. That prompted the NASDAQ to increase its ownership of shares in the London Stock Exchange. These changes by both exchanges reduced the divide and eliminated many of the differentiating factors.
Concept check. 1. How has the role of CFO changed as a result of the passage of the Sarbanes-Oxley Act? 2. Describe the major changes taking place in the U.S. securities markets. What trends are driving these changes?
Preparing for tomorrow's workplace skills. 1. The head of your school's finance department has asked you to address a group of incoming business students about the importance of finance to their overall business education. Develop an outline with the key points you would cover in your speech. 2. You are the Chief Financial Officer of Discovery Labs, a privately held biotechnology company that needs to raise $3 million to fund the development of a new drug. Prepare a report for the board of directors that discusses the types of long-term financing available to the firm, their pros and cons, and the key factors to consider in choosing a financing strategy. 3. Team activity. Does paying dividends enhance the value of a company? Some financial experts caution companies to look long and hard before beginning to pay dividends. They believe that committing to a regular dividend curtails financial flexibility and reduces debt capacity. Dividends might also signal that the company doesn't have good growth opportunities in which to invest its excess cash. Others counter that dividends can help a company's stock by making it less volatile. Standard & Poor's data supports this. Typically, dividend-paying stocks in the S&P 500 outperform non-payers. Divide the class into 2 teams to debate whether dividends add value to a company's stock. 4. Research the trends in the IPO marketplace from 2019 through 2025. Then select 2 IPO success stories and 2 failures. Prepare a report for the class on their performance. What lessons about the securities markets can you learn from their stories? 5. While having dinner at a Manhattan restaurant, you overhear 2 investment bankers at the next table. They are discussing the takeover of Bellamco Industries by Guildmart Corporation, a deal that has not yet been announced. You have been thinking about buying Bellamco stock for a while, so the next day you buy 500 shares for $30 each. 2 weeks later, Guildmart announces its acquisition of Bellamco at a price of $45 per share. Have you fairly earned a profit, or are you guilty of insider trading? What's wrong with insider trading? 6. Team activity. Is joining an investment club a good way to learn about investing in the stock market? Divide the class into groups of 5 to 8 students to develop a strategy to form their own investment club. Use the National Association of Investors Corporation website at www.betterinvesting.org to learn how investment clubs operate and the investment strategy the organization teaches. Each group should then set up guidelines for their investment club and present their plan to the class. After the presentations, the class members should discuss whether they would prefer to start investing through an investment club or on their own.
Ethics activity. In late July 2017, senior management at Equifax, a U.S. credit reporting company, discovered that hackers had stolen the personal data of more than 145 million U.S. customers, including names, birth dates, social security numbers, and driver's license information. In addition, the hackers stole credit card information for more than 200,000 Equifax customers. If that weren't bad enough, reports soon surfaced that 3 top executives, including Equifax's chief financial officer, sold close to $2 million in shares of company stock days after learning about the breach, and more than a month before the company announced the data hack publicly. In a company statement, Equifax says the executives had no knowledge that an intrusion had occurred at the time they sold their shares. The day after the company's announcement about the breach, Equifax's stock dropped by double digits, and the Department of Justice opened a criminal investigation. Less than 3 weeks after the public announcement, Equifax announced its CEO, Richard Smith, would retire, taking a multi-million-dollar payout with him, even after shareholders lost more than $5 billion in stock value after the data breach was acknowledged. Ethical dilemma. Is it legal for company executives to sell stock shares for financial gain when they know impending bad news will cause the stock price to plummet? Does this constitute insider trading?
Critical thinking case. Blue Apron IPO leaves a bad taste. Blue Apron was once one of the top meal kit delivery services doing business in the United States. Started by three co-founders, Matt Salzberg, Matt Wadiak, and Ilya Pappas. Blue Apron provides pre-portioned ingredients and recipes for a meal, delivered to consumers' front doors. Today, the U.S. meal kit delivery industry is a nearly $20 billion business that is expected to reach over $50 billion by 2035, as more and more consumers struggle to find time to go grocery shopping, make meals, and spend time with family and friends in their hectic daily lives. As word spread among foodies about the quality and innovative meals put together by Blue Apron, the company's popularity took off, supported by millions in startup funding. Costs to scale the business have not been cheap. Estimates suggest that Blue Apron's marketing costs have been high. Despite the challenges, by early 2017, the company was selling more than 8 million meal kits a month and decided to go public in an effort to raise more money and scale its operations, including a new fulfillment facility in New Jersey. According to IPO paperwork filed with the SEC, the company had net revenues of $84 million in 2014, which increased to $795 million in 2016. However, those ambitious numbers were not without warnings. Company losses increased in the same time period from $33 to $55 million. Even with those largest losses on its balance sheet, Blue Apron decided to go ahead with the IPO and hired Goldman Sachs and Morgan Stanley, two top stock underwriters, to figure out the right price for the initial offering. While Blue Apron and its underwriters were finalizing stock prices, Amazon announced plans to acquire Whole Foods, a move that could negatively affect Blue Apron's business going forward. Even after Amazon's announcement, Blue Apron and its financial advisors priced the initial offering at $15 to $17 a share and met with investors across the country to inform them about the IPO, which would value the company on paper at more than $3 billion. As part of the IPO strategy, Blue Apron executives needed to communicate a strong financial picture while providing potential investors with an honest assessment of investor demand, especially for institutional investors, who typically are repeat buyers when it comes to IPOs. According to sources close to the IPO experience, Blue Apron's bankers told investors late in the IPO pricing process that they were closing their order books early, which meant there was a heightened demand for the stock, a signal that the stock would be priced in the original $15 to $17 range. A day later, however, Blue Apron amended its prospectus with a price range between $10 and $11 a share, which shocked potential investors. A move greeted with criticism that Blue Apron's messaging now lacked credibility in the eyes of the investment community. If the company priced the IPO $5 lower per share than originally estimated. With that sudden change in the IPO offering, investors walked away, and the $10 initial offering for Blue Apron stock actually declined on its first day of trading. The stock declined to a low of $4.70 in August of 2023, prompting the company to consider its options. With continued consolidation in the meal kit delivery sector inevitable, Blue Apron was at a crossroads when it comes to generating revenue and stabilizing costs while trying to sign up more subscribers. Market competitor Plated was acquired by the Albertsons grocery chain in 2017, and Amazon trademarked the phrase, "We do the prep. You be the chef," as it rolled out prepared food kits in that same year through its Amazon Fresh delivery service. The strong competition in the industry, high costs related to gaining customers, and an overall weak competitive advantage prompted Blue Apron to be acquired by the Wonder Group at the end of 2023. Since the acquisition, the service has been rebranded to offer more meal options, additional features such as family-friendly meals and one-pan meals, and enhanced customization options. Critical thinking questions. 1. What issues should executives of a company such as Blue Apron consider before deciding to go public? In your opinion, was the company ready for an IPO? Why or why not? 2. How else could Blue Apron have raised funds to continue to grow? Compare the risks of raising private funding to going public. 3. Research the history of the company to learn about the factors that led to Blue Apron's acquisition. Prepare a brief summary, including how the acquisition by the Wonder Group could help Blue Apron survive. This has been Introduction to Business, 2nd edition, from OpenStax. OpenStax textbooks and this free audiobook are covered under a Creative Commons license. The full text is available at www.openstax.org. You can find this free audiobook anywhere you listen to podcasts, including Spotify, YouTube, and Apple Podcasts. Instructors can even download a course shell to easily embed these recordings in Canvas courses. Learn more by visiting www.openaudio.us. Did you find this audiobook helpful? If so, please let us know by leaving a comment and sharing this recording with a colleague or a friend.